Hello and welcome to another edition of our RBA Live and Economic Update. I'm joined here by my good friend Evan Lucas, who's also the host of a very, very good podcast called Exchanges with Evan Lucas, mate. Welcome.
Thank you.
Welcome to the show.
You talked about a big show. It's going to be a big show. Just remind yourself.
I shouldn't laugh.
May is also the next update for the statement of monetary policy, so there will be a slight difference. I want to sort of give you a heads up. I might slightly, inverted commas, disappear in the fact that I'm going to dive into it, why Ben's doing his stuff. So be aware, it's not just about the release, which we're about to go through. It's going to be about the statement, but also their forecasts in that are going to be absolutely paramount to how we then judge what the rest of the year will be, because as we're going to go, let's dive into it, because it's just much stuff.
So good segue. What's changed since the last March RBA rate call? Well, we start obviously with the biggest global event that's impacted the markets, which is the Iran-Middle East conflict that continues. So what was meant to be a short, measured attack to obviously dismantle the nuclear powers that Iran held, and maybe also create regime change.
The plethora of other reasons it was
essentially. But obviously we saw the unintended consequences of that, which was obviously the Strait of Hormuz has been obviously blocked, and that's causing all manner of strife in terms of supply chain issues, which is giving us a supply chain shock, not only obviously in the easy ones to understand, which is oil, fertilizer, but we're also seeing gas. Also, obviously, if you can't get it there, you got to go to an alternative energy source, which is gas. So that's also gone up very high. We're now starting to see that flow through to plastics and everything that we're paying. So we'll start to see that. We haven't actually seen any of that except for the petrol prices in the latest inflation data. But we'll start to see it in terms of our food inflation and all that that's going to come through as well.
So, you're going to hear me say this a lot, direct and indirect.
Yes.
So I'm glad you highlighted plastics. I'm glad you started highlighting fertilizer, but it's the indirect impacts that are going to start flowing through July, August, September.
Yeah.
That's probably when you're going to start actually seeing. So it's not just the plastics. We're going to go through construction's the one that catches my attention constantly. So
depending on what the federal settings are as well around where the incentives live.
Fabricated products. So fabricated, let me pronounce properly. Concrete, steel manufacturing. That is all imported.
Plumbing materials, all
that material. So transportation costs of that, manufacturing of them actually physically in the country of origin, transporting them here.
Can I give you a couple of simple examples?
Yeah, go for it.
So one that I picked up on was the lids of the Vegemite jars and the peanut butter jars. 40 cents extra per lid. Right. That's just, so they're obviously 40 cents per unit that they're going to have to pass on. The other one that I saw out of Adelaide was the milk containers. So these milk containers, obviously our 2 litre and 3 litre milk containers, this particular gentleman, obviously his plastic cost had increased by $1.5 million a month. So obviously that's a high volume milk producer and dairy business. But
that's exactly the points, right? So that's the granular indirect impacts of what's going on with the Middle East. And so again, the one that I've been looking at that's quite fascinating, because everybody comes to me on this one, is like apparel is always the sort of the beacon for movement. You forget that, your apparel, yes, this is made with wool, but it's also going to have nylon and synthetic fibers into it to make it stretchy and what have you. That Bangladesh and Vietnam get the 100% of it from the Middle East.
Yes.
And so
and they're on diesel rationings and petrol rationings over in those particular markets.
The supply of apparel,
everything,
will therefore have that indirect impact of the strait being closed. So we're going to go through inflation in a minute. What I'm calling the inflation from March is is basically baseline.
Yeah, it's so effectively that number that we saw outside, like when we look at core inflation, which we'll get to in a second, that hasn't obviously got that baked in, because with core inflation we take out those spiky things like energy. But what you actually see in that inflation read predominantly is domestic demand.
Yeah,
that's domestic inflation. So if the government tries to tell you otherwise, that this is all being caused by the Iran conflict, they are telling a mistruth. They are misleading you to believe that they didn't have inflation already in the economy, but we already know we do, because we've already had 2 rate rises. So we know that's the case. So yes, inflation is heading north. And this is the big chart that we wanted to bring up to compare. This is March to the 28th of April. So this is the ANZ Roy Morgan research that they released. It's the weekly. And this is what we talk about in terms of consumer inflation expectations. So this is inflation psychology. So if we remember what we talked about with regards to inflation psychology, is this concept that we as consumers just say, oh, prices always go up, and we just accept them. And then so that ultimately means that inflation gets baked in, and we know that that's damaging for all manner of reasons. And we'll hear Michelle Bullock say it again. I guarantee she'll say it again in the press conference today, that inflation...
I think the guarantee is more a drinking game of how many times
she
has
says,
to say it, because she's going to get asked in so many different ways the same question.
Yeah. So, and have a look at the scale difference on the chart. So you can see that 7, and this is 7.5. So if you actually look at that, it's material. So this would be weighing heavily on the hearts of the RBA board and the governor in terms of how they try and rein in those expectations, because if the businesses think that they can keep passing on costs and there's no consequences to that, then also the workers think, well, all of a sudden I should get paid more because my money doesn't stretch as fast. So then we get wage price spirals, and then we're in all manner of strife. So that's why we have these settings of 2 to 3% to try and keep the inflation and the economy in check, and try and stretch out the economic cycle as long as we can to get economic prosperity, because economic growth obviously leads to improved living standards, and also your money stretching further for you if you have low inflation. Let's jump into now the headline inflation and also the trim mean.
Yeah.
Over to you, Evan.
So this is why today, as I said at the start, the setup was I need to dive into the statement of monetary policy. So that SMP, that's what that stands for.
Yep.
So you've got their February figure, their November figure in both of these as well. So the big blue line is the actual. We know that the headline, as you can see there, it has spiked away from the expectation off the back of what's going on overseas. You can see that although the Fed expected it to keep going up, so the RBA, to midway through this year, the speed and trajectory of that blue line suggests that it's going to be more than that.
So that's the data you're looking for when you jump into your machine as soon as we get that policy release. And we would expect the dotted line sort of somewhere up here.
Possibly higher.
Here's where we were in November, and this is obviously what's going to be material. So if they think that that's going to happen.
They do. So there's 2 parts to this point. As Ben's highlighted, the trim mean, I'll come to in a minute, but whatever I say, you've got to remember that everybody feels the price of headline inflation, right? So we know the cost of you filling up your car is going through the roof. It's jumped by 37%. We know that if you're filling up a diesel car, it's actually almost 70%. So put that to one side. Food, fuel's another one. So we know that's there. We know that experience is there. That's why that previous chart in terms of what the consumer is feeling has gone so rapidly quickly, because we are very, very acute to those volatile changes in those kinds of things. The trim mean one is the one that we were discussing before about the indirect. And that's why I want to use that term indirect. Trim mean will take 4 to 6 months to pick up what you're seeing in the headline. And that's why the statement is going to be clear about what happens in August, and also what happens in July and what happens in August. But also what the statement of monetary policy is also going to give you is their outlook for the next 18 to 24 months. And you can see on both of those tail charts that they still expected inflation to come back into target.
To the midpoint.
Yeah, into target, into 2028. I think today is going to be a big shock that they're actually going to say it's not going to do that. I think, and that's a really, really hard thing to say, because as I said, if you fast forward
Yep.
6 months from here with what we're seeing on that headline figure, right, you are now saying that that massive surge is going to come through and trim mean September figures in terms of where it is. And it's going to continue to go through because clearly it's not going to just go up and straight back down. It's going to go out. So you can see Christmas is going to have probably a 3.5, 4 handle. And you could make a very clear argument that March next year is going to have a higher 3 handle in the trim mean as that sort of trajectory comes down, because look, interest rates are going to come in. We're going to see it's going to slow it down. The question that we learned from COVID is, did we move too slowly? Hindsight says yes, we did.
Yep. We moved too slowly. Then we obviously got a supply shock from the original Russia invasion of Ukraine.
Yep.
And I think it's important that when we did have those, 14 increases the last time, that the governor was signalling to everyone in their communication that they were going to be patient, that they were going to be willing to hold on to, because remember their dual mandate is obviously getting the inflation target down to that 2 to 3% range. That's that grey area on the chart you see there. But their other dual mandate, part of that mandate is employment, trying to maintain as full employment as they possibly can get. So that's the juggling act that they need to basically balance out. Now, they took an extended approach and signaled to the market that we're going to be patient in terms of bringing that back into that band, and then we would make sure that we're on top of inflation. Now, obviously, we got those couple of rate cuts. That then sparked a further domestic demand, because we didn't see also from a fiscal policy point of view, the government kept spending, and that's not just the federal, that's also all of the state governments, which was pushing too much demand in and not enough supply. And so ultimately, that's how we got domestic-led inflation in our system, because we've also got tight unemployment. So that's the juggling act that they need to do. The $64,000 question this time around is, and if Evan's right and we don't see that long-term projection coming back into the range inside that target area, what are they going to do? Like ultimately, because the thing that's different this time around is this whole concept that the first attempt of landing the plane, navigating, this tightrope that they were trying to do didn't work for them. All right. So, but now we've got this situation where we've already got rising interest rates, but now we've got this. So, and this is where obviously stagnation, which is rising inflation as well as rising unemployment happening at the same time, which is the real problem that the government and
So let's take your point a bit further, because what I will say it directly, what you're sort of skirting around without saying is that will they prioritise one mandate over the other?
Yeah.
And therefore, will they actually forego what they did from 22 end of through to 2024, which was we want to hold on to the good work. I remember that terms. We've done so much work through the last 3 decades to get full employment. We want to keep that good work and not lose it. The question now is becoming, do they actually supersede the employment mandate with the inflation mandate? Technically, under their principle, they're not supposed to, but it is clearly going to. I think, and I will say it that directly, it is clear that what they will say, and Michelle Bullock says it constantly, the media don't hear it because of the way she says it, I'll be honest with you, and that is because she does speak quite high-level boffin, which is that the most detrimental impact to living standards is price erosion. That's what she says, and I've almost learned it verbatim in terms of how she answers. What she's basically saying is that price increases means that your living standards go backwards.
Your dollar doesn't stretch as far as it used to.
Correct. I wish she'd say it like that. So in the end, if we started to see unemployment rise, but inflation come down and therefore the whole population can survive, and it is the word survive, with a more sustained price growth scenario rather than running away and therefore living standards running away, they will probably take that. And they're happy, unlike a government, they're happy to be the bad guy because they're not worried about votes.
Well, and again, the thing that's different this time is that higher inflation expectation, that inflation psychology, it's already in existence, right? The last time that they were looking at taking a patient view is because after the original supply shock, they said it was domestic demand that was the problem. So the reality is now we've had this domestic demand, which is still quite strong. Spending is still up there at the moment. We are going to see a correction because remember, most of the data we're seeing is lag data. So we absolutely feel it out there in the marketplace now. People are a little bit more apprehensive, but we've said this before, and we've been doing this for over a decade. These updates, that if consumers keep spending, then we have a harder time for longer, right? So we'll have higher interest rates for longer.
And the catch with it is Australia is dependent on consumption.
Yes.
Right? So 60 to 65%.
We're a service industry.
Yeah, 60 to 65% of our gross domestic product is on the consumption part of the equation.
Yep.
And we are and have been very much attuned to a living standard all the way up to 2019, possibly even to 2022, I'd argue, where consumption was fine. It was never impacted by anything that really moved the dial, particularly for definitely the last 15. I'd even argue you could go back to the mid 2000s.
Yeah.
When, basically after the 2002-3 downturn, off we went. Yes, we had the GFC, but Australia wasn't overly affected by that. Consumption during that period was still pretty robust. And now we're having this scenario where consumption is a choice between essentials, not a choice between discretionary.
Yeah.
And that is something that, makes people very uncomfortable, having to choose between fresh fruit or processed fruit. They're both essentials you have to have. And that's where we sit, which I'm going to then bring in the next part of the discussion before we get to the actual drop as well, is you've got on the screen the federal budget. We won't get into the housing part yet because we'll do that afterwards. But I do want to talk to you about what you just said then about,
fiscal
monetary side. But and it's a suggestion because we are recording this on the 5th of May. This isn't actually locked in.
Yes. It's another rumor.
It's another rumor.
Out of the Canberra bubble.
Canberra is going to give every working person, unmeans tested,
oh my God,
a one-off, what's being referred to as a cost of living. No, sorry, what was it? An income offset.
Yeah, well, yeah.
Is their term. Income offset.
A cash splash.
Yeah, no, can't call it that.
It is an absolute disgraceful cash splash.
Of $200 to $300 per working person. So that means if you're a retiree or you are on some form of pension, you're not working, you won't qualify for it. If, you're using assets as a form of income, you won't qualify. But if you have a pay-as-you-go tax file, you're going to qualify.
Oh my God.
So my question on that, right? We just talked about everything around the inflation input is.
Can we do the I'm Treasurer Jim Chalmers and I'm ringing you as Michelle Bullock and I'm saying, hey, I'm thinking about giving everyone a cash splash because people are expecting that when things get bad, that the government give handouts.
Yeah.
Right. And how's that going to go for you, Michelle?
But I think we're going to go a bit further than that because again, the argument you can see from them going, and I am going to stray into something.
This is inflationary.
But it's
inflationary.
We're taking one side because they're going to change the capital gains tax and negative gearing.
Yeah.
We won't go to that yet. So we're doing one side, reform.
Yeah.
We have to do the other side, but they forgot the reform part. Do you know what I mean?
So
and you're right.
For most people, they're going to spend it.
Yes.
Like what did we just say before about, the RBA is trying to throttle spending because if they throttle spending, businesses are forced to make tough decisions. They're forced to make tough decisions in terms of
the amnesia is incredible.
It's It's just
so we went through COVID.
What is Cabinet doing?
JobKeeper, right? And the amount of money that in hindsight looks is been the wrong decision, but looked on paper the right idea. You go back to the GFC. We all got $700. Remember the $700?
Oh, anyone who's in cabinet. Right, if you're in the Labor cabinet, but you must have to go and do some economic course before you can actually sit in that cabinet.
They're both as bad as each other too.
I know that. I'm not saying, but it's the economy, stupid. You've got a job to do, and that is to run the economy. That's the job. But unfortunately, in some cases, that they move in cycles. That's what the economic fundamentals say
right now, which we are 9 minutes away from the drop. Is that the RBA wouldn't have been able to factor this in?
Of course not.
So it makes July.
Unless Jim called her, and that's what I'm saying. Let's do a little role play.
Will Jim have called it? No, because Jim's made it fairly clear that he doesn't communicate policy. until it's actual facts, because it's not fact.
Yeah.
And I do want to point that out.
Yeah. We
This is
might
not
be completely
fact.
overreacting.
It is leaked information. So, okay, I'll put my hand up and say that, we're just technically debating a
But they
hypothetical.
lose their economic credibility.
Correct.
If they do something like this, they've got
It
no
would have made
economic
sense.
credibility.
It would have made sense if they turned around and said, we're doing reform with the CGT and negative gearing and NDIS and trust, the other one.
They're coming after trusts.
All of that on this side, and the reform on the other side is that we're going to actually reduce, scrap, whatever, index, take your pick, on the personal income side. That would have been reform.
That's true reform.
Yeah, instead of, and that's, that's a stimulatory measure, but it makes more sense.
Because all we're doing right now is we're raising taxes.
Yes.
That's what we're doing.
What we've heard so far.
Everything is raising taxes, and we're going to give every working Australian $200 or $300 and say that'll help out with your quarterly energy bill that's gone up by 132% since the government said it would actually go down.
Astonishing, right? It's astonishing. It's the same with the energy
I'm
rebates
buying votes, mate. I'm buying votes.
But are you?
But I'm buying votes. Well,
you are buying a certain group of it.
Yes.
There will be a group of people who will just go, thanks very much for your $300. I'm going to go and buy a new TV screen.
So I think we need to explain to people why it's a problem, because here's what happens for a lot of households. That $300 will be spent
instantly.
So like we're talking predominantly 60% of households will just spend it.
Yeah.
And so that just goes straight into businesses' coffers, and it doesn't give the household the discipline in terms of reducing their spending,
which should be argued
which then brings pressure down in inflation.
Yeah, which will be argued. Look,
at the right time.
Yeah, that makes sense, but it's not the right time.
No, like if the business has gone well, pay a bonus.
Yeah,
the business hasn't gone well. The business is struggling. The economy is slowing, and here you are giving cash out, which is higher debt. We're going to go to over $1 trillion of debt. You know, our number one biggest cost in the economy
is interest.
Interest. So how much? Like, is it over 20%? It's not as high as that.
It's not as high as that. So technically, it's welfare. It's 37%.
Yeah,
but that's if you put NDIS in it, take it out, it drops just below it.
Yeah, but interest, because we've got all this massive debt. One job: run the economy, run it strong. Now, we will spend a couple of minutes.
We'll get back to that.
I'm going to talk to you about negative gearing capital gains tax, right? So
you want to do it now?
I think we have to. I think it's important because we could go on all night.
Oh, yeah.
You could be here till 7 o'clock.
Yeah, correct.
Right? So this could go on for a while because we've got a lot to get through today. But now we've got this little window. So we obviously got wind of this in February as a serious thing. Obviously, it's a broken promise. Yes, we know that, and I'll make some statements about that in the future. I'm happy with the capital gains tax reforms because it's stopping the speculators. The property market investors got too big, too aggressive, too speculative. They were buying too many properties. We've lost our social license. Regional properties have gone way beyond their fair value. That's a story for another day. But the reality is that we're going to reduce speculation in the market. And I think that's a good thing, right?
Yeah,
I think that's a good
other
thing.
caveat, just to remind yourself, if it's going down the path that it looks like, which is going back to the 1909 scenario, does mean that because there's no suggestion yet of a cap.
Yep.
But if you were to hold an asset for, let's say, 2 decades,
that's right.
Your discount will actually be more than the 50%.
So if you're going to hold a property for the long term, which provides a social good because it's providing the accommodation for new arrivals and people moving around.
And it's pushing people back to capital income concepts rather than capital growth concepts.
Correct. Yes. So I like that.
Yep.
So happy days. Now I've heard that obviously there may not be guaranteed full grandfathering on that. So obviously the devil's in the detail. But broadly, I made it really clear this is one way in which we can stop the speculators. It won't be.
Because there's enough high-profile people that said grandfathering is actually a shocking scenario.
So we've heard it's going to be tapered off.
It just doesn't work for people.
Now let's talk about negative gearing. Negative gearing. This is the one that does impact supply, and the government are going to pitch, by the sounds of it, as we go to air again, speculative, but it looks like they're moving it. Yeah, hypothetical. Looks like they're moving to a model which they brought into the 2016 and 2019 election, which is we're going to allow negative gearing on brand new properties, but not existing properties. So I will be spending a lot of time talking about that. That will obviously upset a lot of people, and it'll create a two-tier market, and you'll create, explosion in high rental markets on the fringes of town. So rent will be cheap right on the fringe of on the outskirts of town and in the CBDs where you've got a lot of supply.
That one might be grandfathered.
I think that would make a lot of sense. That would be. Well, you would have anarchy because
CGT
people,
not.
well, you lied to us and then you didn't tell us you were changing it. And people have spent trillions of dollars, hundreds of billions of dollars of investment.
Correct. The investment strategy, you can't also therefore the future license of that is that not just negative gearing, but any form of asset investment changes that could be retrospective.
Everyone's already thinking about setting up companies and buying property through so there'll be loopholes. So we'll work out those once all of that detail comes in. But I just thought it's important to understand that, supply is obviously important, but everyone thinks that it just needs to be new supply. The reality is, and to your point, it's going to be inflationary because remember that of the housing component, which is around 21% of the basket of goods, 21 to 23% roughly, in terms of what it looks like. So part of that is rent, okay? And the other part of that is the constructions, the new builds. So if we put a fire hydrant under...
Which at the last update was 6.5%.
Yeah.
Right.
So and it's going back up again because it did get to as high as 12.
But that
annualized about 9.5. But
so the 4.6 that we just saw.
Yeah.
That read from the 29th of April, we should have gone through that, but that is housing was at 6.5%.
Yeah.
4.
I've got that later. I've got some stuff coming through later. So we've got that in the inflation data later when I run through the numbers. But it really is just important to understand that anytime macro, prudential, or regulatory change occurs, in this case, higher taxes on one part of the economy to try and appease or to create an incentive to the other part, there will be unintended consequences associated with this. So we do expect that rents in the middle ring area, in the suburban areas of cities, will go higher because it's just not easy to build enough new stock in those areas. It's easy to build high-rise in the city, and it's easy to build house and land packages out on the fringes of town. So again, be careful in terms of you thinking you're going to get a promised yield and you think that the negative gearing benefit's going to help you. Well, the reality is if you can't get it rented for a reasonable price, the negative gearing is probably is going to help you because you're going to run at a big loss. But that's not why you invest in property. You invest in property over the long term to have a combination of growth in the value of the home and in your returns and also in the passive income that you get off the back of that. And you don't want to be trading or speculating in property because if you do that, everything goes pear-shaped. Now, I need to quickly get the RBA up because it's getting close. It's getting close. We've got a few bits of time here in terms of what that looks like. Oh, I don't want to leave that site. I haven't turned us off, have I? No, good. That was a little bit of a heart attack in terms of what that looks like. Let's bring the RBA page over in terms of we're getting closer to the announcement. So we're obviously calling a rate increase. We can't see it being anything else other than a rate increase given the current situation. But the statement is really important. Are they going to be hawkish or are they going to be dovish? Hawkish means they're going to say we're coming hard down and we probably expect that there'll be further rate rises versus dovish, which means that they're going to take a long period of time. We've clicked over. So what have we got here?
As expected, everybody's doing the same thing.
Yeah, everyone's on the same site. Yes, 25 basis points increase effective from today. That marks the third increase that we've seen. So that's this year. So it's obviously a big call. Let's get back on track here now. So there you can see it. There's the rate increase that was expected at that time. Evan's going to go off and get heavily involved in the statement and give us a summary in respect of that. I'm going to keep moving with some of the inflation data that we were talking about for. So here we go. The annual Australian inflation jumped to 4.6% in March, up from 3.7% in the prior month, making it the highest reading since September of 2023, but slightly below market forecast of 4.8%. Goods inflation picked up 5.5 versus 3.5 in February due to a sharp rebound in transport costs. There's that fuel going through, 8.9% versus negative 0.2 of 1%. As fuel prices surge and rising oil prices linked to the Middle East conflict, additional upward pressure came from food, 3.1% in the reading, alcohol and tobacco, 3.1% versus 4.1%, housing, 6.5% to Evan's point earlier, versus 7.3%, clothing 7.1 versus 4.9, furnishings 1.4 versus 1.3, communications 1.4 versus 0.8, recreation was 2.8 versus 4%. When I'm reading these numbers out, just think that 2 to 3% bandwidth. Anything above that is dragging that up higher than that. And financial services 2.8, so in the range versus 2.4. Meanwhile, services inflation did ease. That's slower to respond, 3.6 versus 3.9, partly reflecting the pharmaceutical costs. Core inflation rose to 3.3% year on year, which is what Evan showed you before. Monthly CPI accelerated 1.1% after being flat in February, marking the fastest pace in monthly increases since July of 2025, but it was still less than the market estimates of 1.3%.
So just quickly going through the policy statement that's just come out there, there is nothing but inflation in the actual paragraphs that are there. So not only that, what they are also pointing out very clearly is that the bank has upgraded its forecasts. I'll come to that afterwards. I'll jump into the monetary statement itself. But the developments in the Middle East means the baseline forecast assumes that the conflict is resolved soon, fuel prices decline, seeing underlying inflation peaking higher than was expected in February, then declines as demand grows. But it's the next bit that really catches the attention. There are materially heightened uncertainties for the outlook of domestic activity. And for that, the Middle East continuing. There are plausible scenarios where inflation is higher, activity lower, envisaged under the baseline forecast. So they've already given themselves room to say they're going to be wrong.
Yep.
Right? Not only are they saying they're wrong.
Wrong on the wrong side of being wrong.
They're wrong on the wrong side.
Higher inflation.
They then say very clearly prices rises get built into long-term inflation expectations, which is what I spoke about at the start of this, which is that
it's a hawkish statement.
It is. Interesting, though, is the very last line. Today's policy decision was made majority 8-1. So there was one member who has said they would rather have it not changed. So that is the only thing that caught my attention. But everything in that statement is very strong to the idea that they still think inflation is to the upside for good reason, and that they are poised to react as required. Let me now dive into the monetary statement.
Go and have a look at that whilst I talk about the trim mean. There's the trim mean that we're talking about, 3.3% year on year. So that's the annual core inflation figure was 3.5% year on year. Sorry, the 3.3 was the monthly number that I just read out earlier, and that was for the first quarter of this month. Then we move into these are some of the ones that I pulled out just to show you and highlight that. So this is the sub-index of the CPI basket. And you can see here the transportation sub-index. Look at that spike, in terms of what that jumped from. So it was 108.37 points in March, a record all-time high, and that was up from 99.28. So 99.28 says that it's disinflationary. Anything you're reading above 100 is inflationary. So that was a massive spike. We haven't seen a spike like that in that particular thing for a long time. Now, we'd have to go back to probably the 70s oil crisis. Let's now look at the next one here. Oh, my system just decided that it had enough. So we'll go back into the presentation. All right, we'll get that back up. Sorry about that, everyone. Here we go. The next one I wanted to show you was the inflation breakdown for food. So we can see here that food inflation, the cost of food in Australia increased by 3.1% in March over the same month of the previous year. For context, food inflation in Australia has averaged 5.3. So we've got a problem with food inflation and our cost to manufacture and deliver food. We're not very productive in this area, and we need to do more about that. In terms of this is the highest reading, was 20.6% in December of 1973. So you want to go back and say, well, what's going to happen now? Because I think food inflation is going to be one of our biggest stories. So what can we learn from the past? Like, why have it spiked so much back in December of 1973? Well, in 1972 to 73, we had the global crop failure. And so Russia bought massive amounts of grain. And then we also had the oil crisis started in October of 1973. And so we had immediate effects to food in terms of, this is what I said before, inflation cost surges, fertilizer and farming inputs rose, and process and packaging costs increase. Everything we're seeing now, plastics are going up, fertilizers going up, transport costs surging. So this amplified the already rising food prices back in that time, which was the reason why it had this massive spike in December. So we haven't seen that yet, but that's the problem that we're potentially looking at there. And of course, back in those days, the wage price spiral was also something Australia learned the hard way and that was that we had a centralised wage system and a wage fixing system back in 1973, and so wages were adjusted upwards, which increased the producers' cost and retailers' cost because they got to pass it on, and that's why we had massive inflation back in the day, back in the mid-70s as well. It was a tough time. So we don't want to learn from those mistakes in the past again. And then the last one I want to show you, which is the one in terms of everyone was talking about food, footwear and clothing. So the clothing in Australia decreased in the last reading to 101.76 points in March, down from 103.66 points in February. CPI clothing in Australia has averaged 98. So when we import most of our clothing goods, it does come in a little bit cheaper than normal. So ultimately, they can produce it at a cheaper rate because the labour cost offshore is cheaper than the labour cost onshore. So that's why we get that type of thing. Now, rental inflation is a significant one. So rental inflation in Australia decreased to 3.7% in March. Lag data, we expect that is going to now rebound back up in terms of with rental supply and rental demand. And of course, if investors are experiencing higher interest rates, they're going to want to try and increase their cost to their tenants because their operating costs have increased as well. So that's just something to also be mindful of. So we think about transport inflation, food inflation, footwear and clothing, rental inflation, all of those things are making up a strong part of the basket of goods in the CPI. That's why they're incredibly worried about where inflation is currently going. And then we now take a look at household spending. Did you want to jump in there now, or?
Yeah, go on. So the statement on monetary policy, as expected, is seeing material downgrades and upgrades in the areas you don't want them. So
yep.
The GDP expectations now fallen to 1.3. Previously it was 1.8. And we basically don't get above 1.5%
yep.
in the forecast going out further. So they think in June 2028,
yep.
we'll still be growing at 1.4. But we'll point out
that's anemic growth, by the way, people.
More than anemic growth.
Yeah.
That, with the margin of error, suggests that the RBA is worried about a recession.
Mm-hmm.
Okay, so that
would make sense.
That makes that. This one fascinates me though, is that
which also indicates that they're going to probably keep increasing interest rates,
which is stagflation definition,
which has to happen to slow the economy down.
Yep.
Which is job losses for everyone's understanding.
Glad you came to that. That
yep.
isn't as high as is expected.
Yep.
So unemployment rate is currently 4.2.
Yep.
They have it by the end of the year still near that at 4.3, which I find fascinating.
I do find that quite interesting.
And out to June 28, they've still got it at 4.7.
Yeah.
Now, all of that's a 0.1 of 1% upgrade.
Yeah.
So if you want to call it an upgrade.
Yes.
On unemployment from the previous one. It's the inflation figures that matter. So they now have inflation peaking this year in June at 4.8. Previous read was 4.2. They then think by the year end it'll be 4% from 3.6. Again, this is what the caveat is to this. This is assuming, and I want to go, you can't see it, but I'll read it out for you. They have a baseline chart for Brent.
Yep. Brent crude, which is the price we pay for oil.
We pay for oil. Not so. Whenever you hear about crude or West Texas Intermediate, that's what the Americans pay. That's not us.
Yep.
They have a baseline where we've had the spike. It'll average about just over $100 a barrel for the very short term of this period in 2026. It'll fall away by the end of the year back into about 80. And if you look at this, you can see by mid-2028, it'll be back at $75
a barrel. Yep.
They then have two adverse scenarios. And both of those see the spike of oil going to about 145 US a barrel.
Wow.
To put that into consideration, right now it's 112. Last week it got up to 125
it did.
A barrel. So we're between the two adverse and the baseline. One shows that it goes protracted and that the oil price sort of slowly goes back below 100. One sees a fairly decent drop and then a kick back up. So the statement that I'm reading out is based on the baseline, which is again why the unemployment rate, I think, is being optimistic. I think that needs to be put out there quite clearly.
Yep.
And I think the inflation read is possibly unders in terms of even the Treasurer admitted that he thinks inflation's going higher. A headline figure in June of 4.8 would be actually something to cheer.
Oh, so these are heroic
numbers,
which is what we'll get in the budget next Tuesday. Heroic numbers to sort of say this is how we're going to get back our deficit, but they're heroic.
So what they're also now factoring in is 3 rate rises.
Yes.
So that's what this next bit is that June 2027, they have headline inflation falling to 2.4 from 2.9.
Yep.
What they are saying is the domestic inflation story that we've been talking about for the last 40 minutes
Yep.
actually gets quashed pretty quickly.
Yep.
And then it will then sort of move back up to about 2.5. That's headline.
Go and have a look at what the future markets are telling us in terms of how
Yep.
many more rate increases for us, Evan, and I'll keep moving through.
Just yeah,
sorry, you got one more?
The final one is the trim
Yep.
mean.
Sorry.
The one
Good
that
point.
matters. So trim mean now is going from 3.7 to 3.8 by June.
Yep.
Probably okay. And then it drops back to 2.5 in 2028, which is actually lower than the forecast. I think
That's heroic.
I think the inflation figures are
Ambitious.
Are rose-colored glasses.
Yes. Well, I mean,
some.
their baseline is a rose-colored baseline like that, and that's what.
Yeah.
They, so
I'm worried about that.
When you compare the oil price movement, the worse the oil price gets, the worse our economy is going to get. It's as simple as that.
The longer this goes, the worse.
Yeah, use that as a quasi line of how how tough the economic situation is going to get down here in this country for a while. All right, let's talk about household spending, because this is the thing that we need to see slowing. And we saw that household spending in Australia rose by 0.3 month on month in February. So it is lag data. This data came out on April the 7th. The next release is actually today in terms of getting some of that extra data out. So we've got to get our hands on that. Spending increased for food, clothing, health, recreation and culture, hotels, cafes, restaurants. We would expect that to start taking a hit now. In terms of contrast, expenditure declined in alcohol and tobacco, furnishings. I mean, you just can't read the alcohol and tobacco one because it's all black market these days. Household equipment was down, transport was down, miscellaneous goods and services down. Now, again, February, this would have been taken before the US sent the missiles into Iran in terms of that story. So not a healthy story. Moving on to the unemployment, this is the stuff that matters in terms of our seasonally adjusted unemployment rate stood at 4.3% in March, unchanged from February and in line with forecast. Still the latest reading retained at the highest level since last November, even as the number of unemployed fell by 3,700 to 656,300 from 660,100 in February. The number of part-time job seekers fell by 3,800 to 217,500, while those looking for full-time work rose by 4,600 to 438,800. Meanwhile, employment rose by 4,600 employment rose by 17,900 to 14.77 million, below estimates of the 20,000 increase, which was the weakest jobs growth since the contraction last November, and forwardly upwardly revised gain of 49,600 in February. Full-time employment increased by 52,500 to 10.17 million, while part-time employment dropped by 34,600 to 4.59 million. The participation rate edged down to 66.8 from February's fourth month high of 66.9. The underemployment rate held steady at 5.9. Meanwhile, total monthly hours worked across all jobs rose by 9 million to 2,016,000. So that just gives you a bit of an idea in respect of that. So we were watching the unemployment story because I think their numbers are a little bit ambitious in terms of what that looks like. Then we go to the Westpac and Melbourne Institute Consumer Sentiment. So it fell off a cliff, dropping 12.5% in the month off the back of what's been happening with rate rises and confidence in the Australian market. So spike in fuel prices, rising interest rates triggered the biggest fall since COVID. Near-term expectations dropped back to the 2022-2023 cost of living crisis lows. Job losses fears jumped 5.5-year high, a 10-year high post the COVID era, and consumer are much less bullish about house prices. So look at those sub-indexes. You can see it. There it is, falling off a cliff. You can look at a time to buy a dwelling. Traditionally, it's actually gone up. That's people potentially saying, well, yes, if prices are falling, not a bad time to buy. And then you've got the house price index expectations. This is the one that's dropped significantly. Look at that. That's what we always said. People think prices always go up in property, but they don't. And potentially some of the further settings that we're seeing from governments could see some price corrections in certain markets. And as I said, I'm quite concerned about regional markets at the moment. Okay, so we can see, and then the interest rate expectations also sitting very, very high. So this is what is worrying the Reserve Bank and the board. Right, we then look at the business confidence. So you can see here the pattern that happened during COVID, very, very concerning. And look at what we just see in the new NAB Business Confidence Index plunged to negative 29 in March from an upwardly revised 0 in the prior month, marking the second largest monthly drop on record and the weakest reading since April of 2020. Hence why we think the RBA has got their forecast wrong. The sharp deterioration reflected fallout from the Iran war, which triggered a global oil shock and weighed heavily on sentiment. We all know that. Despite collapsing confidence, business conditions did hold steady. A little bit of good news in there. At 6, sales edged lower, 11 versus 12. Profitability was weak, 1 versus 4. So they're taking the heat in the cost and their profits are dropping, highlighting major pressure on input cost, which surged by 3% quarter on quarter. Firms appear unable to fully pass on higher cost. That is a good sign. Retail price growth easing to 0.5 of 1%, down from 0.9, signaling softer pricing power. So when we have a look at that and we move that into the property market, we're still seeing multiple markets within markets here. We've got our two biggest economies suffering falls in both the month and the quarterly reading. Yet we see still Brisbane, Adelaide, Perth still quite strong. But I can tell you, looking at our data that we get on a daily basis, it's very clear that the momentum in the broader Australian economy is slowing quickly and property prices are starting to cool. So overall, growth slowing. Every capital city recorded a slower pace than what they did in April. Auction clearance rates are falling in the main capitals. So we are definitely moving into our property prices are falling, the wealth effect of that's going to hopefully help with consumers. So we're going to have to take the Band-Aid off people and take our medicine. And I'm hoping that the RBA will let that happen pretty quickly, go hard early, and then reset expectations, reset entitlement, reset all of those things. Won't be good for the politicians in terms of their economic credentials and what they get judged for by voters when you can't manage the economy properly. Some of that in their control, some of that out of their control. I want to be clear about that. But you can see then the long-term trends of some of those markets through that. So in terms of third straight monthly rise, increased by greater than 1% for some of those other markets, but still Sydney and Melbourne underperforming. Auction clearance rates, as we say, are cooling a part of that particular story. So wrapping up the Aussie economy and the property market before we move into our wrap up of that, and I'll get Evan's final comments in regards to this. Winter is coming for the Australian economy. Make no mistake, the size of the economy's economic slowdown will depend on the Iran conflict and domestic inflation, interest rates increasing, consumer and business and government spending. So hopefully the governments also exercise restraint so we can reset. We can't be an economy that grows at 1 to 1.5% a year. That is anemic. We need to move back to the 2 to 3% that we expect, and we need to make sure that our policy and economic settings and reform settings around all of the sort of regulations we have can adjust for that. Last words for you, mate, before I move on.
So last words, most markets are pointing that August is live, July not so much, which is what we had before. Most of them are certainly suggesting that the peak argument will it be 4.6 or will it be 4.85?
Yep.
I think, again, judging by all of the fairly inverted commas, rose-colored glasses, optimistic, pie in the sky statement of monetary policy is that 4.6 looks to be the target for the RBA. But again, they have given themselves some pretty decent wiggle room that if the two adverse scenarios come about, 4.85 by the end of this year looks pretty likely. And it should be the highest since 2012.
And I think that one of the board members who dissented probably would have argued a case that just the fuel cost alone, because what Evan was saying earlier about whilst, everyone can argue how we measure inflation and basket of goods and all that.
Yes,
we know that households are hurting and spending a lot more. So they're probably arguing that you don't need to go as high because all of that money has been stripped out of a lot of households who have mortgages on their property or potentially who are paying rent and just general living costs. So that's what they're potentially hoping for.
Yep.
So whether they have to pull the third trigger is the question. I would bake in at least one more.
Yeah.
But I'm certainly
not ruling out one.
I'm probably thinking more two than one.
Yeah. And I think the reason July will be that pause is that, like the argument was when they cut 3 times, they'll argue on the way up the same thing. We now need to actually see it filter through.
Yeah.
We are talking about 0.75 of 1% in the space of less than 5 months.
Point. Yep.
I mean, it's obviously a little bit more than that, but that's what we've seen.
Yeah.
That therefore has to take effect.
It has to. I mean, if the conflict and the crude oil goes above 125, 130 a barrel, they'll have no choice.
Yeah.
They will have no choice. But these are all the moving parts. And so, ours are best guesses as well as anyone else.
We better keep moving.
We better keep moving. Yes, we've got more to get through. So this is the other biggest, obviously, story around the globe at the moment is what's happening in the US. We didn't spend any time in terms of looking at other Euro markets and so forth. We're going to spend a bit of time looking here at the Trump experiment. Let's look at the updates. All roads lead to the AI investment. There is over $1 trillion has been committed to chip fabs, data centers, agentic AI. It's definitely adding incredible power to their GDP. But, as Ev and I were talking off air before, it's not trickling down or spreading out to the broader economy, and small businesses are definitely being impacted. We're going to see what happens in terms of their employment story. Domestic inflation, that's coming back, and we're going to look at that now. And of course, we get a new Fed chair announced in literally days in terms of what's going to be happening there. So let's take a look at the economy, because we did get some GDP numbers. So you saw a strong bounce back in the US economy, expanding by 2.7% year on year for the first quarter, slightly above the previous period of 2.2%, according to the preliminary estimates. If we look at the quarterly basis, the economy expanded at an annualized rate of 2%. If we go into having a look at those quarterly basis numbers, we can see that the annual 2% per quarter of Q1, 0.5 from the previous quarter off the back of the government shutdowns. Government spending rebounded 4.4%, recovering from the 5.6% contraction in Q4, those government shutdowns. Gross private domestic investment, this is the big story here, which is the AI story, increased by 8.7% compared to 2.3% in the previous quarter, with business investment in equipment and structures surging 10.4%, the fastest in nearly 3 years, driven part by the rapid spending on artificial intelligence technologies. Consumer spending, which accounts for roughly 2/3 of the economy, rose at a slower pace of 1.6% in Q1, following a 1.9% increase in Q4, supported by demand for services. Net trade contributed negatively to GDP as exports rose 12.9%, while imports jumped at a faster rate of 21.4%, thanks to the collapse of the tariffs. Quick, get everything in there as quick as you can before it moves on. So that's where we sit in terms of year-on-year Q1, in terms of that. Now, the inflation story here, this is what leads us into the Fed's recent announcement. CPI in the US, look at that spike, like in terms of the 0.9% month over month in March, the largest increase since June of 2022, following a 0.3% gain in February. Energy prices rose 10.9%, led by a 21.2% jump in gasoline, which accounted for nearly 3/4 of the increase due to the impact on the war in Iran. The shelter index also increased by 0.3. So then we have a look at this. The result was the annual inflation rate in the US jumped to 3.3. This is the problem for the US that Evan is going to talk to. It's the highest level since May of 2024, and a sharp increase from the 2.4% in both February and March. These figures come in line as forecast, but in case of the month-on-month price increases, the rise primarily driven by higher energy costs, as we talked about before. On the other hand, used cars, trucks continue to decline, while inflation steadied for shelter and also eased for food. So they have a bit of an okay story, because they are energy independent in the US, so they don't have the same sort of problem. They can create their own fertilizer. They do. They're not reliant on that fertilizer like we are from offshore. So they do have some things in their favor, but generally this is a problem, isn't it, Evan?
Yeah. So this is twofold. This is rate cuts to the federal funds rate.
Yes.
which is coming up as you'd expect.
Yep.
You have the war in Iran, which they are not immune to, despite what the president might tell you, because WTI, although that's what they price off, isn't as high as Brent. It has increased by 30%.
Well, that's that.
Diesel is not able to be excused either with regards to the price they've got there. The next thing to also look at is that the tariffs that have been there, not the Liberation Way ones, the other ones that are in part of it, is that they're now reflecting in price. And you look at that chart, even with the chart you've got on screen, at no point have they actually gone to 2%. So their target isn't a band like us, 2 to 3%. Right. They have a 2% target. And everything that was, particularly the big, beautiful bill, was a stimulatory measure in terms of what it is. And
high government spending. Correct.
And so we now have that coming through. So none of this surprises me in the slightest. And what I'm seeing again is that, okay, if you strip out the AI, they have the same stagflation problem the rest of the world is facing as well.
Yep.
And so the GDP figure at the moment for me is fascinating because government spending is driving it along with AI. So it's private investment and public investment. Consumption in the US is going backwards. And as you just rightly pointed out, net exports is going backwards as well. Yes, it's because they're restocking at a lower price. But in saying that, they were still a net importer anyway of product. They were just taking the price. Now the price is reduced because the tariffs aren't like they were this time last month. So
it is a fascinating story, right? Because the flow of capital into that market is extraordinary. And of course, the capital that's being generated through private equity and sort of the investment funds and so forth, it's coming from obviously Middle East and other parts of the world. All of those flows are going to the US. Now, one could argue that if they weren't doing AI, what would that money be invested in, right? So in other words, if you strip out, because Evan's 100% correct, you take that out and they've got a stagflation story. But if they weren't investing there, they would be deploying that money somewhere else. And whether that's global or whether that was in the US, look, everyone knows that this technology is transformational. It's the first time in history that we're manufacturing intelligence. So it is going to be meaningful in terms of what it has from a productivity point of view and from an economic point of view. So we understand that race is on. And unlike the tech bubble and the dot-com boom, this time there's actually revenue there. Whereas back in those days, Amazon wasn't producing much revenue. The revenue has been staggering for the likes of Anthropic and that type of thing in terms of their run rate. So what did it mean in terms of interest rates? So we saw the Fed kept the Fed funds rate unchanged at 3.5 to 3.75, target range for the third consecutive meeting from last month, in line with expectations. This is where it gets fun, mate. This is like a melodrama, this thing. It's unbelievable.
I'll get your popcorn out.
The decision was not unanimous, with Governor Moorr voting to lower interest rates by 25 and 3 other members objecting to the language in the statement that suggested the central bank would eventually resume cutting rates. So we've got effectively 3 members who are saying, this is stupid. We want to be lifting out of the 8. So the vote was 8-4, marked the first time since October of 1992 that 4 officials dissented against the decision. The central bank reiterated that we'll carefully assess incoming data and evolving outlook and the balance of risk in determining the appropriate stance of monetary policy, and stands ready to adjust policy as needed in the risks emerged that it could hinder the achievement of its objectives. In addition, the Fed noted that the development in the Middle East are contributing to a higher level of uncertainty about the economic outlook. Meanwhile, Powell, who's the current Fed up until this month, said he will remain as a governor, which is normally most of them do.
He may actually remain as the chair for the next meeting as well.
He may if they don't
this
announce.
would have been his last one.
Correct.
So Kevin Moorr has not been confirmed.
No.
He has now cleared the Senate, which is probably his biggest headache.
Challenge.
He'll probably now clear the House, but it may not actually happen before the next meeting.
So in other words, Powell might get a bonus one. Fascinating story. I mean, this is popcorn stuff in terms of what's going to be happening here. We have got just differing views.
And that split is huge. You cannot get apart. 3 members are now saying that they don't believe the next movement is down.
No.
They want that removed. You can see that also what doesn't get captured in that is that the 8 members that are there, they've got a whole bias in general.
Yeah.
Stephen Moorr is the only Trump appointee. So Kevin Warsh coming in, he's also said lately that he is going to be independent of the president. You've got to also remind yourself, don't forget, Jay Powell was appointed by President Trump in his first term, with the idea that, again, he was going to follow Trump's ideas, and he has shown himself to say, no, I'm a technocrat, I'm doing what my mandate is, and my mandate is to get straight out 2% inflation, and I haven't achieved that. I need to point that out. He hasn't done what he needed to do.
No.
So that's
look, it would be silly to think that the US could justify, and it would collapse the markets if they put a rate cut in there. Like, it's just dumb. So we're not going to see a rate cut in the US anytime soon. And to your point, it's most likely going to be higher than up rather than down. All right, let's look at the unemployment story, because this is what is playing out. The unemployment rate fell to 4.3% in March from 4.4% in February. Again, a little lag data, not too much, but lower market expectation. The number of unemployed decreased, and then whilst the total employment fell by 64,000, the labour force declined by 396 to 170 million, pushing the participation rate down by 0.1% to 62.9. Meanwhile, the broader U6 unemployment rate, which includes discouraged and underemployed workers, rose to 8% from 7.9. So we're going to watch that unemployment story in America more closely. Non-US farm payrolls. This is the stuff that Evan and I look at, because this is the main crux of what's going on. The US economy added 176,000 jobs in March, the most since December of 2024, following a revised.
This is why,
because it bounces around.
This is why at the moment the data's been not trusted.
Yes.
So this chart is the perfect illustration of why it's not been trusted. At no time in history have you seen
this type of bounce.
Intra-month.
Let me read it in terms. So the figures came well above market expectation of 60,000. Job gains were concentrated in healthcare, 76,000, construction, and also transportation and warehousing created another 21,000 jobs. Manufacturing added 15,000 jobs. Employment and social assistance continued upward trend, 14,000. On the other hand, federal government unemployment continued to decline, 18,000, and declines were also seen in financial activities, negative 15,000. The change in payroll from January was revised up by 34,000 to 160, and the change for February were also revised down by 41,000 to 133,000. So lots of ups and downs. The net result, which is what everyone was getting to, that the employment combined over the 2 months saw a 7,000 lower than previously reported. So you're going to see that these numbers were bouncing around. So it is getting a little bit more.
It's so hard, therefore, to actually read it.
Yes.
Because this is actually what people are pointing out. This is actually an impact of Doge, because the Labour Force Bureau has been gutted.
She got sacked for giving a bad result.
Correct. And you don't actually have full opaqueness of the data.
No, that's right, when you get an authoritarian in power. Hey, this is the other one we always talk about in terms of consumer sentiment. So we can see here that the University of Michigan's Consumer Sentiment Index was revised up to 49.8 in April for an initial estimate of 47.6. So a little bit more of a positive push there, according to the final data. Despite the slight improvement, this means that the weakest reading on record, reflecting the lower level of the Iran conflict, or the heavy toll, I should say, of the Iran conflict on consumer morale. Sentiment decline across all demographics regardless of political affiliations, income, age, and education. So that's something to keep an eye on. Then we move into, obviously, retail sales. So there is a strong number here. Retail sales rose sharply by 1.7% in March, surpassing market expectations of 1.4, following an upwardly revised 0.7. So the consumer is still spending in the US. This marks the steepest growth since March of 2025, driven largely by a record 15.5% surge in gasoline. So it's like that's where you got to get into the data. Number looks good on the page, but that's because I just got to put it into the gas tank, right, with my paying for gallons of fuel that I do. Despite rising pump prices, consumer spending remains solid across all other categories. I won't go through those. We'll be here all night. In terms of the IMS manufacturing PMI, the US remained unchanged at 52.7, so it's in expansionary territory. 50% is below that. In April, matching its highest level since August of 2022, but falling short of market expectations. New orders grew at the fastest pace and supplier deliveries lengthened further, whilst production expanded at a lower rate and employment levels declined at the sharpest pace in 4 months. So some okay news in terms of that sort of manufacturing area. But let's wrap up the US by saying that the onshoring strategy of the US government hasn't quite materially shown up yet, but there are some green shoots in terms of what's happening there. We're going to see what that does to the longer term market, because if it's not evenly spread, we're going to see some political challenges for the Trump administration. The Reserve, I've got the Fed Reserve is a must-watch drama. It's going to be fascinating to see that.
Like you and me, it's astonishing what's going on.
The Iran war still remains problematic economically and also politically for Trump. And we've got this supposedly US-China summit that's meant to happen on the 14th and 15th of this month, where we're going to hear hopefully some economic collaboration or announcements, or some steadying of the ship, globally, geopolitically. We'll see what happens there. So there is some important key takeaways. Let's look at China quickly. I'll just rip through some of these charts to just give you the main bread and butter in terms of what's happening here. We can see quarterly GDP data came out on the April 16th for Q1, and the GDP grew by 1.3% quarter on quarter, which maxed market expectations. The latest result marked the strongest quarter expansion since Q4 of 2024, supported by continued government policy settings from Beijing. So that was a good news story for them. In terms of their inflation story here, we've got past this disinflation and deflation risk that we're seeing here. So annual inflation eased to 1% in March from February, over a 3-month high of 1.3%, falling short of market expectations. Food prices rose, but pretty much everything else is A-OK there, so I won't spend too much time on that. The People's Bank of China maintained its key lending rates, so no changes to interest rates in their April release. In terms of the story around unemployment, the China's surveyed urban unemployment rate rose to 5.4% in March from 5.3%. Their biggest problem is their youth unemployment that's happening in there. We're seeing that being a big problem. So that still remains problematic. They've got to get that domestic economy firing further to support the 1.3 billion people who are in that population. Consumer confidence, we did get an update on this, which is normally doesn't happen, but we did see a number come out here. So saying that consumers are getting a little bit more confident. So the trend there is improving with an increase, but still below that 100 benchmark, which is obviously optimistic versus pessimistic. In terms of the retail sales, we can see they're still reasonably anemic, not still punching out above their weight in terms of what they've got. Business confidence, certainly in expansion territory. So the official NBS manufacturing PMI inched down to 50.3 in April from a March 12-month high of 50.4, but surpassed expectations of 50.1. The market, the second consecutive month of expansion, so they're feeling okay there, but still struggling to get that economy moving. Key takeaways: China's oil reserve and the government interventions have definitely cushioned the local economic impact from the Iran conflict. Now, we said here a couple of months ago that the US might have been using that as a leverage as part of the summit, but obviously China has done well with their 6 months of oil reserve and have managed to keep those fuels on shore, including their avgas fuel as well. We passed the point, as I said before, about the large deflationary risk, what we call demand side impact of the economy. It's very dangerous when that demand drops and you can't get it back up, you can't get that economic flywheel moving. And I talked about, the summit between Donald Trump and Xi Jinping in May is very important for both economic countries. Let's wrap it up now with a global look at the second biggest economy in the world. When you put the aggregate sum of these economies together, we are talking about the Eurozone. The Eurozone expanded by 0.1% from the previous quarter in 2026, missing market consensus of 0.2% expansion. But the data reflects the pressure on the tight supply of energy that is essential for the majority of the economic bloc after the outbreak of the war in the Middle East. So they've got those same problems. Well, that correlated into the GDP expanded over an annual period of 0.8 of 1%. and that was below market expectations of 0.9, and obviously dropping from 1.3% in the last quarter's reading. A lower house price or household consumption was noted amongst the largest economies of the bloc, with growth slowing in France, Germany, Italy, and the Netherlands. Spain's an outlier at the moment, performing with GDP expanding at 2.7.
That's the new
from 2.6
Prime Minister in Pablo.
Yeah,
He's certainly changing things up in there. So
He's-
Spain's an interesting one. It's
he's
a
getting the economy moving.
socialist left Prime Minister with the
With
largest rainbow coalition Spain's ever seen.
Yeah,
And he's doing it.
with central right mandates.
It's fascinating what he's up to.
It is. It's
also,
contradictory
don't
to
forget,
what he is.
He's the largest European leader that is pushing back against what Trump's doing in Iran. So he's still expanding Spain, despite the fact that he's actually getting pressure from the other side of the Atlantic. Spain at the moment is watch that space.
Well, the problem with Spain, and we're going to see that in this number now, when we look at, well, that's the annual inflation, but let's look at the cash rate. They left the cash rate. The European Central Bank kept the cash rate unchanged in its April meeting as policymakers adopted a cautious stance assessing the impact of the Iran war on inflation and growth. Meanwhile, the ECB remained well positioned to navigate uncertainty. Officials noted the upside risk in inflation and downside risk to growth has intensified. What does that mean? They emphasised that long-term inflation expectations remain anchored, though short-term expectations have risen significantly. At the post-meeting press conference, the ECB president, Christine Lagarde said the decision to hold rates was unanimous, although policymakers debated various options, including a possible rate hike. I think that might also be on the cards for them, signalling that, there's more upward risk to interest rates in the EU. And then when we go to that employment story, this is the one I wanted to highlight. So the area seasonally adjusted unemployment rate, 6.2% in March, revised from 6.3 in February, in line with market expectations. The number of unemployed people fell by 63,000 for the month to 10.98 million unemployed people. This is the knockout number. Meanwhile, youth unemployment remained elevated, with the youth jobless rate starting at 14.9% in the euro area, unchanged from the previous month, and 2.35 million young people under the age of 25 remain unemployed in the Eurozone. Among the major economies in the bloc, Spain, still 10.3% unemployment, but that was a lot higher. At one point there was 21%. France, 7.7%, Italy, 5.2% recorded the highest rates, whereas Germany, 4%, and the Netherlands, 4%, some of the lowest rates of unemployed youth in that bloc. All right, let's bring it home. Consumer confidence and sentiment. We saw the euro area drop to a negative 20.6 in April. That's lower since December of 2022, compared to negative 16.4 in the previous month. That's a big drop. Okay, obviously, what did it drop from? We know, right? European Iran war, Middle East conflict, that's definitely sparked inflationary pressures off the back of that. Has prompted the correction in consumer confidence and sentiment there. In terms of retail sales, we saw a sluggish number of retail sales, down 0.2 for the month in February, following the stagnation in January, and in aligning with market forecasts. Food, drink, tobacco sales all down as part of that particular story. Business confidence in the euro area decreased by negative 0.28 points in April from 0.27 points in March. So we can see they've got this history since Russia. You can see that invasion. So you've got the little COVID. Then you can see where they're still continuing to have challenges in terms of business confidence. So wrapping up the key takeaways for the euro, they've got high youth unemployment is telling their story. Their heightened regulatory settings continue to be an economic break, in my opinion. Their AI regulation is very, very conservative. And as such, they're not getting the innovation and productivity spikes. They've got massive problems with energy costs. So I just made a little sort of dig at them. They still remain the 1800s and the 1900 economic darlings, but little has changed to recapture that former glory. They're not going to be the economic darlings of the 20th and 21st century. That's for sure. Final comments and observations. What have we got?
Yeah, so why I've been quiet probably for the last 10 minutes is I'm just reading what the Treasurer is saying.
Let me guess, he's not blaming government spending?
Correct. So RBA not blaming government spending. He notes that the RBA statement is important to recognise it does not point to public spending, as a factor for their decision to increase interest rates today.
Conveniently left out.
So I think there's a reason it was left out, is that there is so much of, but again, the takeout from pretty much most people's view is it is a hawkish movement. They think July is probably less likely because they'll let the 3 put through. But in most people's opinion, August is absolutely live.
Okay. Well, maybe you should say that. Is there another live rate hike? Maybe at the next meeting. We've got a question mark on that. So I preempted that by saying we don't know. But of course, the further deterioration in terms of what's happening with the Iran conflict, that will potentially also see potential further risk if oil prices and other commodity prices keep going higher. I don't think they'll have a choice. We're just going to have to grin and bear it. The economy is definitely slowing in Australia. We know that some of the economists are now predicting a negative Q1 and Q2 quarters, which combined could be a technical recession. So that's something to keep an eye on. Federal budget drops next week. That's what we're going to be spending a bit of time on. Evan will be on a special episode. We've also got the chief economist of Bendigo and Adelaide Banks, who's going to be joining us to dissect the broader, budget. And then Bryce Holdaway is back for a special edition of the Property Couch, where we'll also unpack the property market changes and reforms and try and digest what we think will happen in terms of behaviour in those two particular markets. In terms of the Iran and Middle East conflict, the longer it carries on, the worse the economy is impacted, I think, is the key takeaway here. And let's see what the US and China agree to in terms of their upcoming summit between the presidents of both nations. Always remember that the information we provided here today is not investment advice, and so always make sure that you seek out independent advice as part of that. Mate, thank you for another wrap. Now you're up next week in Canberra,
yes,
to do the reading. Budget. You're going in the lockup to get through the budget there.
Yes, it'll be. Lockups are great. But yes, I'll be there. So I'm looking forward to coming back on the 18th to have that big deep dive about where it is. I mean, again, reading what I'm reading at the moment, I actually do hope there's some broken promises to lead to reform. But for everything we're saying is that reform has been done at the margin. It's not being done correctly. No. And so that will be the discussion and what we're going to be waiting for. And again, show me the incentive, show me the outcome.
Correct. Your big passion is less tax on income.
Yep.
More tax on capital.
My big passion is diversifying the capital base.
Yes.
So that means that we have to have the incentive for people to actually want it to work.
Correct.
And if that isn't there and feeling that working gets you ahead, you're not going to do it.
No.
So
if the government can give me handouts,
correct,
then I'm not going to work.
Capital, taxing capital has some merit, not full.
Yep.
I'm going to be honest with you about that.
Yep.
But what I'm saying is that my passion is the tax mix is clearly
wrong.
Still wrong. It's from the 80s and early 90s and hasn't changed since.
So you would have liked to have seen, okay, if we're going to tax property investors a lot higher, which is what's going to happen, and all investors, obviously capital gains.
Yep.
Capital gains tax reform looks like it's going to be on every asset class, not just on property.
Barring super.
Which
again is the problem.
Yeah.
Right. So I've been pretty passionate about this. Superannuation is a vehicle for the wealthy again. I mean, the intention of it is fantastic.
Yeah.
But
what do you think everyone's going to do? They're going to set up self-managed super funds and invest in property.
Correct. So this is what
that's not advice. That's not advice. I'm not saying
this is where we're at, right? So you can see how complex it is. Ben and I continue to pull our hair out in the fact that the super tax breaks, because that's what they are.
Yep.
Are so generous that it's attracting assets into it for good reason.
Yep.
You should be putting it in there. Again, not advice.
Yep.
But we're also one of only 3 nations on the planet that doesn't tax pension phase. And the tax that we get out of super is too low. If we're going to tax assets, superannuation has to be included in that, because then we wouldn't have to hit property between the eyes.
Well, but if we also took a slither of tax on all property and not just on principal place, if we took, personal use property profits, take a slither of that as well, we could potentially do a little bit better there as well.
The monkey in the room is the GST.
Oh, of course. We've got to do something about that.
Consumption taxes.
Consumption taxes are good. They're good taxes because the more you spend, the more tax you pay. Anyway. Thank you, everyone. Until next time, remember, knowledge is empowering, but only if you act on it. Thank you, Evan.
Thanks, mate.
For another great update. And we'll see you in July.
6 weeks from now.
6 weeks. Bye for now.